Hi, this is Andy Myers in for Claus Vogt on Money and Markets TV. Many of our editors have been discussing the deteriorating economic picture in the U.S. and around the world. Over the past month or so, things have gone from bad to worse. The housing market is slipping again, with home prices in 20 major U.S. cities falling to their lowest levels on record. The job market is getting weaker, with only 54,000 new jobs created last month, and consumer spending is mired in a long-term funk. In fact, nearly all forward-looking U.S. economic indicators have turned sharply lower, and they're not far away from levels that would signal another recession. But even if a double-dip recession doesn't happen, a severe bear market is certainly still possible. We may be seeing the beginning of that bear market already. Risk-sensitive sectors like small-cap stocks, emerging markets, and commodities are breaking down. And even though technical indicators show that the selling over the past 6 weeks is overdone, the market has not been able to rebound in any significant way. We can see this most clearly when we look at the S&P 500. It recently fell through the support level at 1,300 without a backward glance. Usually, short-term support acts as a springboard to launch a rally. But the fact that this didn't happen means that the market's character has clearly changed. The bullish forces have weakened, and the bears have gathered strength. Another bearish indicator is the increase in margin debt on the New York Stock Exchange. Historically, major market tops have been accompanied by spikes in margin debt. We saw this most dramatically in 1929, when buying stocks on 10% credit became a national pastime. More recently, the 1987 market crash was heralded by margin debt reaching 1.8% of the total market cap. The 2000 bubble came with a spike to 1.6%. And during the stock market top in 2007, margin debt rose all the way to 2.3%. During the ensuing bear market, it declined, but not by much. And now it has come all the way back, a strong indication that there's another market top in the making. This fits perfectly with another contrarian indicator, mutual fund cash levels. Mutual fund managers are as prone to hurting as anyone, and their track record is clear. When they're close to fully invested, it's a bad time to be in stocks. That's exactly what we're seeing now. The most recent readings show that fund managers have been holding a record low cash level of 3.4% for the past 2 months. But as I said, it's not just the US market that's breaking down. Interest rate spreads are widening for the European countries that are having the most trouble meeting their debt obligations: Greece, Portugal, Italy, Ireland, and Spain. U.S. financial institutions have sold credit default swaps on roughly half the debt of these countries. So if the PIGS nations default, the banks are on the hook for 50% of the resulting losses. With so much uncertainty, we believe the stock market will continue to slump. To profit from that decline, consider inverse ETFs that are designed to rise when the market falls, like the ProShares Short S&P 500, ticker symbol SH. Try to pick up that fund at around $41.5 to $42.5 per share. Thanks for watching Money and Markets TV.